A very good morning to all and pleasant welcome to our Q3FY18 earnings call. Before getting into operational and financial numbers of the quarter, I would like to highlight that during the quarter, bank has raised Basel III compliant Tier 2 bonds aggregating to 490 crore rupees. Further, as permitted by the shareholders in the last annual general meeting, our board meeting held yesterday accorded approval to go ahead with augmenting the paid up capital by issue of up to 20 crore equity shares of face value of rupee 1 each through QIP route. The price, time and other details of the issue will be intimated in due course. This additional capital along with current year flowback of profit is expected to provide us enough leverage for our growth plans. During the quarter, we have won Digital India Excellence Award 2017. This prestigious recognition for our innovative mobile application Digital E-Lock was given in the 5th Pan IAM World Management Awards 2017. Now let us discuss the key highlights of our operational and financial performance for the quarter ended December 31, 2017. Our net profit for Q3 at rupees 115 crore registers a return to normalcy after an unexpected reduction during the trailing quarter and as against 111 crore rupees for the same period last year. Pre-provisioning operating profit stood at 330 crore rupees for the quarter. The decline in the PPOP on a YOY basis was mainly because of the reduction in treasury gains. Other income, excluding profit on sale of investments, grew by 12% to 148 crore YOY. The profit on sale of investments was at relatively low level of 11 crore for Q3 FY18 vis-a-vis 127 crores in Q3 FY17. Net interest income stood at 509 crore rupees for the quarter as against 418 crore for the corresponding quarter last year, witnessing growth of 22% with net interest margin for the quarter at 2.88%. As on December 31, 2018, total business of the bank stands at 1,19,747 crore rupees, an increase of 11% YOY. Total deposits increased by 7% YOY to 68,109 crore and total advances increased by 16% YOY to 52,449 crores. CASA of the bank increased by 443 crore to rupees 16,929 crores, registering a growth of 2.69% YOY. CASA now stands at 24.86% of total deposits. NRI deposits stand at 18,375 crore with an increase of 13% YOY. Advances grew by 16% YOY to 52,449 crores. The growth drivers continue to be SME loans, mortgage loans, agriculture advances and auto loans. Retail portion, excluding gold in the total advance, stands at 22% and has increased to 11,700 crores from 9,200 crores for the corresponding quarter last year. And MSME loans stood at 25% with an increase of 21% YOY. Among others, contribution from corporate loans was 18,598 crore, which stands reduced to 35% of the advances book. Agriculture portion in the loan book stood at 14%. These indicate the clear shift of our focus to retail and MSME segments as in line with the guidance given earlier. 74% of our corporate loan book is of investment grade of triple B and more. The accounts below triple B has come down significantly from 35% last quarter to 28% in the current quarter. The breakup of corporate loan book of more than 25 crore stands at 18,598 crore. The major constituents are financial intermediaries 23%, infrastructure around 15%, metals around 6%, etc. Our investment book stood at 18,945 crore, of which HTM contributed 14,279 crores, AFS 4,660 crores, and HFT contributed 6 crores. We continue to have zero watch list in our large corporate book. Gross NPA stood at 3.40% vis-a-vis 3.57% for Q2 of FY18, and net NPA stood at 2.35% versus 2.57% for Q2 of FY18. We believe that we have successfully managed our NPAs in spite of a challenging business environment. As guided earlier, total non-fund facilities amounting to 150 crores in a pharma sector NPA account got devolved, and against this we had already made a provision of more than 90 crores, and during the quarter we have done the additional provisioning to complete 100% provision in this account. Provision coverage ratio stood at 49.35%. Our capital adequacy stands at 12.51% as of Q3. Cost to income ratio stood at 45.12% as against 48.53% for the same period last year. As on date, the total employee count stands at 7,364, excluding subordinate staff. During the quarter, bank had opened 16 ATMs and 1 extension counter. We now have 851 branches, 53 extension counters, and 1,370 ATMs. With this, we open the floor for questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Vital. Please go ahead.
Hello. Hello.
Hello. Yeah.
Good morning, sir. Thanks for the opportunity. I have a few set of questions. Firstly, what is the outlook on the business growth both in advances and deposits for FY18 as well as in FY19, and what would be the key drivers behind that?
Yeah. The advances growth that we have committed to the market is 18%. We have reached 16% so far, and we believe we will be able to achieve that by the year end. And going forward, our desire is to grow at 20% plus. And in terms of deposit growth, it will be just in line with the advances growth. Only in terms of CASA, we have a very specific target of at least 25% growth.
Okay. Secondly, sir, if you can provide me the breakup of reduction in NPAs in terms of recoveries, upgradations, and write-off.
Sure. The cash recovery was 20 crore. Upgrade was 77 crores. And write-offs were 152 crores. Therefore, the total was 249 crores.
Okay. And so what is the average ticket size and the yield that you see in housing loans?
Average ticket size is around 25 lakhs for the home loan.
Okay.
Yeah.
And so any comment on your margins, which is usually in the range of 2.8, 2.9? Do we see further scope of improvement from here on?
We have been guiding 2.85 to 2.9. For the moment, we continue to hold on to that.
Okay.
We are not expecting a significant improvement in that, yes, at the moment.
So what is your outlook on fee income for the coming quarter?
Other than treasury, 25% growth will be coming in. Treasury, of course, in the current environment, it is not quite predictable. So other than treasury and forex, it will be 25% fee income. That is our target internally on a YOY basis.
Okay. And so,
Ma'am, may we request you to come back in queue for follow-up questions? Thank you. We'll take the next question from the line of Sri Shankar from Prabhudas Lilladher. Please go ahead.
Hi, congratulations for a good set of numbers. Mr. Pratyush, you have kept the company, the bank has come out with performance as guided. My quick question to you is, what is the status in the restructured accounts portfolio? Are we likely to see any improvement, or can you give some color on it, please?
Yeah. The restructured portfolio now stands at 248 crores. So that 248 crores contains mainly two annuity-based road projects. And basically, because it is an annuity-based road project, there should not be too much of a risk associated with that of turning into NPA. Yet, in the current environment, we are assuming that, even in the worst case scenario, even that can slip. But that's about all. That's all what we are having at the moment in the entire restructured portfolio.
That's a restructured standard.
That's right. All the rest anyway is NPA.
Okay, that's all. And on the other side, corporate, you mentioned that your watch list is 0. So that stand you still reiterate going forward for the next quarter also?
Absolutely.
Okay. Thank you. I'll come back to Q&A.
Thank you. We will take the next question from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir. Thanks for taking my question. Sir, couple of questions. One is on growth. So, after a long time, we have seen sharp improvement in the Kerala-based portfolio growth. So, sequentially, that portfolio has grown by 9% QOQ. And I suppose which is highest in last 18 quarters. So, can you please throw some light on, what are the key drivers in Kerala, or, what are the green shoots you are seeing going forward in Kerala portfolio, or let's say in overall Kerala economy?
Yeah, no. Basically, what's happening is the focus on retail loans and MSME, which for some time, unfortunately, was not fully there in our system because we had gone more into the corporate kind of expansion in particularly in the period 2010, 11, 12, 13, etc. And therefore, the Kerala portfolio became a secondary kind of a portfolio. So what we have been now mentioning is with the retail coming back, the growth is coming exactly in line with the distribution of the branches. There is nothing else about it.
Okay.
So if you look at the advances position today, total advances, Kerala continues to be a little less than non-Kerala because it is only 41% Kerala and 59% non-Kerala because still we have corporate advances driven out of, say, Hyderabad, Mumbai, Delhi, etc. But if you look at the growth, I have the breakup of that. If I see the advances growth, 56% has come from Kerala on a YOY basis and 44% has come from outside Kerala.
Okay.
And the branch distribution is precisely that. Branches are 55% Kerala and 45% outside.
Exactly.
So that is the only difference that is coming in today. That is, there is nothing very unusual happening or anything. It is exactly in line with the branch distribution. Every branch is able to now work on advances because the focus is on things which they can do very easily, like MSME, agri, auto loans, lab, home loans, even gold. So any branch can do. Therefore, the focus has come back there, and the growth now we are witnessing is exactly in line with the distribution of the branch network.
Okay, so it is fair to assume that going forward the traction in Kerala portfolio which we have witnessed in current quarter, that will continue going forward also.
Absolutely.
Okay. Okay. Sir, just a small clarification, on PPT slide number 36. So if we look at the gross slippage number, it is almost flat at sequentially, at 258 crore. But when we look at the segment-wise slippage ratio, most of the segments have, declined sequentially. So how is it possible? I mean, when you have
I can immediately connect one point, that is, one account was not appearing in anything earlier because it was a non-fund facility.
Okay, so you have recognized that into NP in this quarter, or what?
I had to, because this was a running battle with RBI also, because RBI wanted to classify this account as NPA for maybe more than a year.
Okay, got your point. So since it was a off-balance sheet exposure, it is not shown in the PPT.
We have been providing for it, but then we can't make it NPA until it crystallizes. It crystallized in this quarter. Therefore, the whole thing became NPA. We provided 100%, and in fact, we have written off also at the moment.
So out of this 258 crore, you are saying 150 crore is the that non-fund based exposure converted into this.
Exactly.
Okay. Thank you so much, sir, for clarification. Thank you, sir.
Thank you. We will take the next question from the line of Jehan Bhara from JM Financial. Please go ahead.
Good morning, sir. Sir, again, my question is on the same point. So our slippages this quarter was at 258 crores. So, sir, if you could just elaborate, since our watch list is zero, restructured assets are same, QOQ.
Yeah.
So, if you can just throw some light, exactly,
where it came from. Yeah. I can mention that because the normal slippages are 98 crore. Then there is an increase in drawings of 160 crores. Now that increase in drawings is not about 160 crores. It is 150 odd crores, 151 crores or so is only in one account, which was lying as a non-fund facility, converted into a non-fund facility in 2014 with a maturity in 2018. Now, it is nobody's argument that, this account is in great shape or anything, but at the same time, we could not have recognized it as an NPA because it is non-fund facility and there was no invocation on that. And therefore, even we had a divergence with RBI last year also. The same divergence came up even in this year in 31st March 2017. But we could do anything about it only if there was an invocation. So that has got crystallized in this quarter. And therefore, 151 crores came from from a non-fund facility, which is neither in the restructured book nor in the NP, nor in the watch list or anywhere, because it is an account which is something which you have been mentioning for about a year now.
Okay.
Yeah.
Okay, sir. So sir, can we assume that this is the new normal rate of slippage of about 100 odd crores, or there is still some pain left?
This would be more or less. Only thing is, that a restructured standard of around 240 odd crores is there. So fine, we will deal with it as it comes. But otherwise, this is more like the normal, 100, 120 crores should be the kind of slippage that one should expect.
Right. And sir, accordingly, that is the reason that our provisions have also come down from a run rate of say 200 crores to 154 crores. The
provision has not really come down, but already provided for this non-fund facility earlier, significantly. Around 90 crores we had provided for.
Okay.
So that became a right back kind of thing.
Okay.
Otherwise, it would not have been there like this. Yes. Otherwise, the provision is more or less in that 200 crore which we have been guiding.
Okay. Fine. So, sir, for FY19, the quarterly run rate for provisioning should be how much, sir?
We would expect it to come down by half almost, or thereabouts. Yes.
So close to 100 odd crores, maybe
around that much.
Okay. Thank you so much, sir.
Welcome.
Thank you. We will take the next question from the line of Anirban Sarkar from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thank you, sir, and congratulations on a good set of numbers.
Thank you.
Just one question. I see that on a sequential basis, your yield on advances has declined by 15 basis points. So, could you throw some light on that as to how that happened?
Yeah, one of the reasons is that the focus on Kerala-based advances and which are highly collateralized. That means,
Okay.
we are taking in many cases, sometimes even more than 100% collateral security, apart from the primary security, by way of, say, residential mortgages, other land mortgages, etc. And therefore, the pricing is not, exactly in line with, the particular segment. For example, like in an MSME segment, you might look at maybe 10.5, 11 kind of pricing, but that kind of pricing doesn't happen when a significant collateral security is taken. So that is the one reason that is coming in, and so more or less we expect that the pricing may not improve significantly.
All right, okay. And sir, the other question is, I see there is an employee count reduction of around 73 in this quarter. So has there been a right sizing of branches, and so what would be the strategy going ahead?
Sir, here it was purely retirement and a little bit of attrition. It's mostly retirement.
Okay.
A lot of people retire in November. That's a pattern in our, Kerala kind of scenario. It is typical.
Okay. That's it, sir, from me. Thank you, sir.
Welcome.
Thank you. We have the next question from the line of Anurag Mantri from Credit Suisse. Please go ahead.
Hi, good afternoon, sir. Just one question. Your provision coverage, excluding the written-off accounts, is about 30-31%. So any comments on that? You would like to increase it, impact on credit cost?
Right. So, we are provided for completely in line with the regulatory requirements, including the IBC accounts, having to have 50% provision. So we are completely in line with that. Only thing is, because of the significant attrition of NPAs in 2 quarters, that is Q1 and Q2 of this year, there is some more time before you build up, the provision coverage ratio to 60-70%. So I expect a significant improvement. Even in this quarter, it has improved, and I'm sure it will improve in the next quarter also further. So it should be more like maybe 55 kind of thing in the next quarter, and thereafter 60, and things will improve like that. Of course, I mean, what you are talking about is the PCR without the write-off, that is around 32, more like 31.77, I believe. So that also has seen an improvement vis-a-vis the last quarter. So going forward, I think our comfort level is anything between 60 and 70. So the target is to reach 70 at the earliest.
Sure. Thank you, sir.
Thank you. We'll take the next question from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, if I go to slide number 29, where we have mentioned the depreciation on investment, which is around 4.5 crores, which given the yield movement during the quarter looks very manageable. So any comments there, sir? Was there any offset or, just curious to know why was this provisioning, it looks lower side. Any explanation there, sir?
The only explanation is that, we had booked a little bit of loss early in the quarter and then cut the positions, anticipating that things are not going to be very favorable. So, and then that is one of the reasons why the profit has not increased, or is not in line with what was there last year.
Sure.
From 137, if you look at the treasury and forex together, it was 134.70 in Q3 of last year, and this quarter what we have ended up is 17.86. So there is a decline of actually 86-87% YOY.
Sure.
Yeah. So that has come. The thing is, we did not hold a large position, which would have otherwise resulted in a huge negative.
Mm-hmm. Sure. And so secondly, on the disclosure on the rating profile, so if I see, let us say, BB rated corporate at somewhere around 16%, and then we have less than BB at another 10%. So does that worry you in considering the current environment?
It does not. The reason is it has actually improved even on a quarter-to-quarter basis also. And the next point is that this is our internal rating, and we maintain a very tight internal rating system. And secondly, there is also a high orientation towards collateral security in our case, both in Kerala and most parts of South India in any case, where we insist on getting, and we have been successful in getting good amount of collateral security apart from the primary security. So therefore, a little, numbers not exactly coming to the best level, even those things are quite acceptable to us when you look at the amount of collateral security that is available to us also. So there is a high amount of risk mitigation that is available to us.
Sure. And so just lastly, you did mention that there is no corporate watch list, but just like any other risky exposure where you have non-fund based exposure outstanding, and possibly you see a possibility of that getting crystallized in near future.
We have no non-fund based facilities other than this, which we had always been mentioning. We have been mentioning this more than a year and a half, because this is converted and given to us in 2014 and with a maturity of 2018. So that was the only one that was there with us, nothing else.
Sure, sir. Thanks very much and all the best. Thanks.
Thank you.
Thank you. We will take the next question from the line of Harish Kapoor from India Infoline. Please go ahead.
Hello, sir. Just wanted to check a little bit on the provisioning front. I missed that part. So you're still maintaining for the next quarter is going to be around 200 crores and around 100 crores per quarter is what the FY19 guidance is?
Yes, 100, 125. Let us say about 1% credit cost may be a more reasonable way of looking at it, slightly less than 1%. So we are looking at advances of at least 50,000 crores, already 52,000 crores. So if you look at it, 1% also, it is coming to just about 500 crores. So we are looking at maximum credit cost in that range. That's about half of what we are having today.
Sir, and secondly, just want to understand on the NCLT account that you had mentioned that around 880 crores of exposure and you have around 25% to 50% provisioning and the rest will be made by Q3 and Q4. So how much of that has already been made? Has the NCLT account provisioning been completely recognized or how is that?
The NCLT accounts are 660 crores for accounts, and we have a provision of 41% at the moment. The remaining 9% will be made in the Q4.
Okay. And sir, what is the impact on due to the wage provisioning that you have made?
It is almost 10 crores we have provided this quarter.
Okay, fine. That's it from my end. Thank you.
Thank you.
Thank you. We will take the next question from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Hi. Good afternoon, sir. Thank you very much, sir, for the opportunity. Now, sir, my question pertains to the way even the steel sector and in the metal sector, the improvement that we are seeing. Do you expect in any kind of exposure in these segment? Do you see any kind of reversal that might come? Have you done any kind of such analysis at your end?
In our case, basically, the larger steel accounts have all gone into either NPA book or it has already been sold out. So, any recovery or benefit will have to come from two sources. One account is in the NPA book, which is going into the NCLT, and if a good resolution comes, obviously there is going to be a benefit.
Okay.
And on the other hand, the accounts which are already sold out, to the ARCs, if upgrades happen, recoveries happen, we get definitely an opportunity to share in that, because it is 1585 formula that we have followed there. Right. So obviously we will be getting an 80% of the upside.
Right. So in terms of upgrades in ARC, any kind of a possibility that you can see over next 1 year or any thoughts on that would be helpful.
So we were looking forward to, at least in the case of say metals, particularly steel, we should get we should be having a good resolution is what we are hoping. But at the same time, we don't have any clarity at the moment because we have to see exactly what is going to happen in the NCLT in the next say few months.
Right. And any further SR downgrade that is what pending or it's all done? That I think we took a quarter back, right?
Correct. We had taken additional 25% provision as coming out of the rating agency's evaluation of the net asset value. So now that portfolio carries slightly more than 50% provision. If you look at the 1,776 crores that we sold out in March 2017, it is already carrying 50.14 or so, 50.14 to be precise. That is the provision it is holding.
Right.
I hope at least that much value is available, remaining value is available definitely in the company.
So basically you do not expect any further impairment on your SR book, right?
No, we were not expecting even the last one.
Okay, understood. And on other income, basically, what is the? I think we have seen even 280 crores kind of, and then 160 crores, and you have been maintaining 210 crores is what is a sustainable kind of other income that one should see going forward. So is that what you still kind of hold? Any thoughts on that?
Yeah. See, the problem is, we need to look at the non-treasury part of it. So if you look at it, last quarter we had 204 crores kind of number, but that contained, some one-offs and also, as we had mentioned, some amount of priority sector lending certificates which we sold out in that quarter. It doesn't happen every quarter in the same manner.
Right.
And therefore, so maybe what happens is in the first quarter, we will get all the priority sector lending certificates that we sold out in Q1. So the benefit of that they will come back to us, and again we will be able to sell it again in the Q1. So that number is the only one that creates a little bit of volatility, but that also when it is apportioned among all the quarters, we should be able to do a growth of 25% on a YOY basis.
A growth of 25% that you're talking ex-treasury or what?
Ex-treasury. I'm only talking about ex-treasury. Treasury part, there is no clarity at the moment unless we know something very precisely about the rate of interest movement.
So in current quarter, 160 crores, how much was treasury and how much was non-treasury? Like ex-treasury, how much was that number?
Yeah. So in this quarter, treasury and forex was 17.86 crores and others were 140.96 crores.
141. So on this 141 crores is what you are saying you will see a growth of 25% is what?
Absolutely. Right.
Okay. Sure. That's it from my side and all the very best and thank you.
Thank you.
Thank you. We will take the next question from the line of Sangeeta Purushottam from Cogito Advisors. Please go ahead.
Yeah. Thank you, sir, for taking my question. I just wanted to understand that in this quarter we've seen a slight uptick in the cost-income ratio. If you could explain why that is. The second question is that, while we've been discussing that you would like to see a higher growth in CASA and your target is also fairly aggressive. So far, the growth that we've seen in CASA has been below the target. So how do we plan to achieve this, the target that you've set of 25% growth in CASA? And the provisioning guidance that you have given of about 100 crores per quarter roughly next year, will that be adequate to take the provisioning coverage ratio to the desired level?
Yeah. The cost-income ratio part of it is more about income than the cost. Cost, of course, has increased in this quarter because of the employee provisioning seeing a significant increase because the IBA-related negotiations have started and therefore we have provided for 12% growth in the salary expenses, which is significant. So therefore that has added to the cost a little bit.
Right.
But more than that, on the income side, the treasury, last year it was treasury and forex was 134 crores and this quarter it is 18 crores.
Right.
Yeah, so that would significantly alter the cost-income ratio number. So that is the only thing that is coming in. Otherwise, everything else is fine. There is no change in the cost structure or income structure.
Right.
Now, when it comes to, the CASA issue, I accept that, the growth rate is definitely very muted.
Yeah.
The fact is we need to look at the base that we had in December. Post demonetization, significant amount of money got deposited into all the accounts. They got activated very well. And it's a fact that, we have not been able to maintain that.
Right.
much of it has got converted into fixed deposits, etc., over a period of time. So that is the main issue today.
Right.
So, and then what do we do about it? Yes, I mean, there is nothing other than working very hard on that with each account. That is the only solution. So every branch is focusing on that, and all the retail products are getting rolled out very correctly. And with the greater customer connect that comes out through rollout of the retail products, that is very important. The retail loan products are very important for CASA growth. So in line with growth in the home loan, auto loan, LAP, and personal loans, etc., we believe that the CASA can also grow. And we are also focusing on the NRI part of the CASA, which has actually helped us a little bit in this quarter.
Right.
Because it has grown much better than the remaining part of the CASA.
Right.
So we expect will help us, particularly in Kerala, which accounts for 91% of NRI business.
Right. So, sir, from which quarter do you think we are likely to see the CASA numbers start to pick up if last year was a high base effect?
Yeah, basically, I think the high base effect will, decrease quarter after quarter. So in two quarters, actually, it will go away more or less. And so we expect that, from September onwards, you would find that, the CASA growth is back to whatever we are talking about. Definitely.
And you hope to sustain that?
Definitely. Because demonetization was a particularly, one-off kind of an experience, and otherwise everything else is intact. The rest of the growth is coming out quite well.
Right. Okay. And on the provisioning coverage?
Provisioning, see, as I mentioned, the credit cost will be at the most 1%, and that means around, say, 100 to 125 crores in a quarter. That is what we are talking about.
Right.
So, that we are very sure is enough to meet, the provision coverage ratio improvement that we are looking at. We are looking at, say, a comfort level of around 60%.
Right.
70% is absolutely fine for us. So that anyway will happen over the next 1 year.
Okay. All right. And so one...
Ma'am, I'm sorry to interrupt, but may we request you to come back in queue for follow-up questions? Thank you. Participants, you are requested to limit your questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. Thank you. The next question is from the line of Rahul Ranade from Goldman Sachs Asset Management. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Just 2 quick questions. The first one on the breakup of provisions slide. So I see an 87 crore write back in the other provisions line. So just wanted to know what that pertains to.
Yeah, this provision, as I was mentioning, towards the pending development of non-fund based facilities, we were building a provision earlier.
Okay.
So that was around 90 crores.
Oh, I get it. So you kind of write it back from here and put it in the NPA line.
NPA provision. Yes, exactly.
Okay. And just one more question. So actually, just looking at the corporate exposure. So I think the financial intermediaries line accounts for, I think, a fourth of the overall corporate exposure. So just wanted to get a flavor of what kind of exposure this is to what kind of financial institutions.
Basically, some of them are, these are primarily NBFCs, and some of them are AAA rated. Some of the largest exposures are all AAA rated. Some are AA rated. And so we are extremely selective about, this particular sector. But this has been an important sector for the bank. And we, of course, don't have too much of a room to grow there. No.
Okay. All right. Yeah. Thank you.
Thank you. We'll take the next question from the line of Rahul Bangaria from Lucky Investment Managers. Please go ahead.
Thank you for taking my question, sir. My question has been answered. Thank you.
Okay.
Thank you. We'll take the next question from the line of Rajat Jain from Principal Mutual Fund. Please go ahead.
Yeah, thank you, sir. So just a small question. So you mentioned in terms of restructured assets, about 248 crores worth, and essentially on 2 annuity-based road projects. Now, I just want to know as to how is it that they are under stress? Is it because these road projects weren't completed or the annuity didn't come, or what really happened, sir?
Actually, in one case, the annuity has already started, and the other case, the PCOD is awaited. In fact, it is more about, the promoter issues. Like, it's not about, what happens to the particular project as such. If it is getting completed, obviously we should be able to get everything. But the promoter may be having issues with NHAI on many other projects also. So therefore, we are not 100% confident that, it will not slip at all. But whatever happens in this scenario is that, there is always a step in right and things like that, and therefore we are not going to lose money.
Okay, thank you, sir.
Thank you. We will take the next question from the line of Hiten Jain from Invesco Asset Management. Please go ahead.
Thank you. So my question is on cost of funds. How much impact?
Excuse me, Hiten, you're not audible.
Yeah, is it better now?
Yes, thank you.
Yeah. So how much impact do you see on cost of funds due to the current rise in bond yields this quarter?
Girish would like to take?
Yeah, the cost of fund per se has not increased for us. On a cumulative basis, it was marginally declined during the quarter, because we have got the deposit which is getting repriced, which was running at a higher rate than what we are giving today.
Okay, so incrementally you don't see any negative impact on cost of funds?
Going forward, the benefit which hitherto we are getting will slow down. But immediate impact we don't foresee.
But because of the MCLR regime, as the deposit cost increases, the advances return also will start improving along with that.
Okay, so you net you see a stable NIM for FY19?
Absolutely.
Okay, all right. Thanks.
Welcome.
Thank you. We will take the next question from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yes, sir. Thanks again. Sir, just a small question on our security receipt book. So what's the outstanding security receipt book as of now?
1,280 crores at the moment. Okay, sorry, I think reduction from 1,274 is the right number. Sorry.
Okay, and we are having a 51% provision on this portfolio.
49 if you take the full value, 49.05, because I was talking about the latest sell-off, that is 1,776 crores. On that we have 50.14.
Okay.
The previous ones carry a little less, and therefore the net number is 49.05%.
49.05 is the blended provision which we are having on this portfolio.
That's a haircut we have taken already. Yes.
Okay. And sir, the exposure on NCLT which you have mentioned about 660 crore.
Right.
So this is including both the list, right?
This is including old and new, everything. Yeah.
Okay. And we are having 41% coverage on that portfolio.
We are having 41% at the moment.
Okay. Thank you so much, sir.
Welcome.
Thank you. We will take the next question from the line of Cyrus Dadapoy from Anand Rathi. Please go ahead.
Yeah, hi, sir. So there's a QIP which you have mentioned in yesterday. What's the floor price around? So it would be around 650 crore totally.
See, the timing etc. is yet to decide. So we are unable to give a precise pricing on that.
And what's the loan growth target for next 2 years or so, just to understand capital consumption?
This year we will do 18%, and even this year also the internally agreed number is actually slightly higher, around 20%.
Okay.
And going forward also it will be 20% plus, including all the sectors, including the corporate book. I mean, that is, the blended growth will be around 20%.
20%.
20% plus.
20% plus for next 2.5 years.
Next 2 years, definitely.
Okay. So second question regarding Ind AS, are we ready in terms of quantification of ECL impact on the book, and what's the potential impact on net worth?
We are ready from the preparedness aspect,
okay,
but we are still refining the ECL models.
Okay. And has RBI communicated anything? Any date? Is June possible, or is the June deadline coming through?
See, as far as our preparedness, we are ready with that.
Okay.
but RBI is yet to announce any modification from their earlier target dates.
Okay. So do we know the impact on the HTM part of the treasury book?
Yeah, everything has been considered, but it is too premature to make it to the outside world.
Understood. And so finally, just any color on NCLT 3 list? Has RBI told you anything on that?
Please come again on that, like NCLT?
NCLT 3, there's there's talk about an NCLT 3 list. So have we heard anything from RBI?
No, certainly not. We have not received anything. No.
Okay,
yes.
Understood.
And in any case, in the large corporate space and all, we don't have anything more left, I suppose, yeah.
Okay, understood. Thanks, sir. All the best.
Welcome.
Thank you. We will take the next question from the line of Sneha Ganatra from Shubhkam Ventures. Please go ahead.
Sir, my first question is on the margins. Currently, our margin stands at 2.88. What is the outlook for FY19, assuming it around 2.85 and 2.9, assuming a 20% plus credit growth and the CASA at 25%?
Yeah, around 2.85, 2.9 is the expected growth, yes. Expected level.
And considering whatever the buffer provision will be required for the transactions of the India, is that also guidance we have considered in our credit cost, or additional can come?
No, this is not, anything further is not counted in the credit cost, which we were talking about as slightly less than 1% going forward. And ECL, as the CFO was highlighting, ECL computations and preparedness is quite ready, but at the same time, we would like to refine the model. We are also trying to figure out a lot more about it in consultation with our consultants, and we are also waiting RBI guidelines also on that. Anything further on that? Yes.
Yeah. And considering your recoveries and upgrades, it stands around 97 crore. How do you see this run rate expecting for the next quarter as well as the next fiscal to be?
We expect, the cash recoveries to be something like this or even slightly superior, and even upgrades. I mean, there was a time when, the recovery and upgrades used to be almost like the slippages.
Right, very true.
And so that's the kind of level we are ideally looking for, but at the same time, at least 50% of the slippage we should be able to, do as the recovery in a particular quarter. That is what minimum target is.
Okay, and the run rate of the slippages would be around 120 crores, right?
Yeah, that I think more or less that would be the level going forward in the 2019 kind of scenario. But before that, of course, one more quarter we are expecting maybe. We are saying that it may be the worst case scenario may be like the current quarter.
So by FY19, where do you see your ROEs to be settling?
ROA in the current expectations, we should be able to reach an ROA of 1, maybe at least in one particular quarter. Suppose depending on how that quarter performs. Like if we have a quarter like what we had last quarter, like the last quarter, when all and minus the provision, then we can definitely achieve an ROA of 1. But then for the whole year, if you look at it, we won't be able to achieve an ROA of 1 in 2019. It is more in 2020.
Okay. And 20 plus capital growth you are saying for 19 as well as 20, right?
Pardon me?
The growth capital, 20% plus, that you are saying for 19 as well as 20.
Yeah, absolutely.
Okay, got it. Thank you.
Welcome.
Thank you. We'll take the next question from the line of Bhavik Dave from Reliance Mutual Fund. Please go ahead.
Hi, sir. Sir, I just want to understand your view on the Kerala economy, because we've been having some significant growth in that segment, in that geography, and as we've known that geography was going through a difficult time in the last 1 year. So can you share some thoughts on what segments are growing, how are the disbursements in the different retail segments that we are into, and secondly, how the gold loan book that you're looking at, because it's been flat for quite some time now. Do we expect any growth from there?
Yeah. In fact, gold is one segment where we have not done well enough, because our internal target was 20% and we have been able to achieve only 13% as of now. And it is not just Kerala alone. We got about Tamil Nadu and there are 3 regions in Tamil Nadu and one region in Bangalore, which are very important from the gold perspective, and everywhere, I mean, we have been facing constraints in terms of achieving a 20% growth. So we are working towards that as of now. But otherwise, if you ask about the Kerala economy, yes, I mean, some of the sectors which faced significant problems earlier, such as the plantation sector like rubber and the spices, things have started stabilizing. I won't say that it has started, expanding so very well and things are very fine. That is not the case, but the comfort level is there at the moment about the prices which are there in the market as far as rubber and spices are concerned. So those things are very important. Then if you look at the services sector, there is a certain amount of stability, and the expectation is that there would be growth coming back in that sector quite well. As far as our business is concerned, because the business is entirely retail, the focus is on retail, that is MSME, agri, home loan, auto loan, LAP, gold, everything. The growth is coming exactly in line with the branch distribution. That's all.
Sure.
So we have 55% of the branches in Kerala, and the growth is also coming at around 56% from Kerala.
Sure.
Right.
And sir, do we expect any employee additions because we will focus on retail and SME as a segment to growth? The number of the employees that are focusing on this segments, will that increase, or then the absolute number of employees will increase for us?
Yeah, we need to recruit some more people. For some time we have not been recruiting in large numbers. Maybe this year we would have to look at around 600 people to be inducted, and that's the kind of number that we are looking at.
Sure, that's it. Thank you, sir. And one more last question is, have we changed any incentivization for the employees for them to be motivated or focused towards these retail and SME segment, which are technically more difficult to source than a larger ticket size loan? So is there any change in the way the communication to the employee goes now?
Yeah. The incentive plan of the bank is very much aligned with the corporate goal of retail loans and CASA. So these two are the areas in which people get the retail loans, CASA, third-party products, and recovery in NPA. These are the four areas in which the branch managers would be able to get maximum incentives.
Sure. Okay. Thank you, sir. All the best.
Thank you.
Thank you. We'll take the next question from the line of Kashish Bambani from Niger Capital. Please go ahead.
Hello, sir.
Yeah.
Sir, my question is on the retail banking. This quarter we have done revenue of around 607 crores, and the segment result we have done profit of around 91 crores, which is significantly lower when I compare it on QOQ and YOY basis. So what is the reason for this?
Girish would like to take the question.
Yeah, in fact, if you see the profit before tax is already tallied with my P&L.
Okay.
But segment-wise, all the segments are now in profit.
Hello.
Yeah, all the segments are in profit now.
Yeah. But why is retail down, sir?
See, that is based on the cost allocation basis. So,
if you could throw some color on this, sir, because I'm not able to understand why is this lowest.
The thing is that there are certain assumptions on allocating the cost basis, interest cost and the admin cost basis is, it is due to the basis which is consistently been followed. This kind of anomalies could be there. It is not on a account wise or on a granular portfolio wise allocation is happening.
Thank you. We have the next question from the line of Arjun Tandon from Matsya Capital. Please go ahead.
Yeah, thanks for taking my question, sir. So you mentioned that the pharma account was due to this divergence from RBI. Now, is there any further divergence that might be possible in the book? Has RBI communicated anything?
So we had divergence primarily in this account, which was continuing in for another year actually. and another account where they had a different date for the NPA classification, and both have been completely provided for. One is as such, they wanted 100% provision. We have made 100% provision completely. The other one, there was a provision shortage that is also taken care of. Remaining things are very, very small kind of cases. There is nothing. Absolutely.
Okay, so as of FY17, there is no further divergence.
No,
and all has been taken care of.
Apart from this, there are no other divergence. These are the things that is coming up in FY17 also, which was coming up actually in FY16 also, I suppose. That is one account. Yes. Correct.
Oh.
We are done with that completely.
Oh. Thank you, sir.
Welcome.
Thank you. Participants are requested to limit their questions to one per participant. Thank you. We have the next question from the line of Giriraj Daga from KM Visaria Family Trust. Please go ahead.
Yeah. Hello, team. Just one question regarding the SME loan per account. So what is our latest, like let's say last 1 year, what is the average ticket size we are seeing?
You have the number for SME. 33 point? Okay, 23.50.
But isn't that on a total basis? I'm looking for the incrementally. Your number has moved from 16 to 23. So I'm assuming the incremental load would be coming at such a higher level of 30-40 lakh?
Yeah, incremental will be slightly on the higher side. So that is obviously the orientation today. The idea is to capture higher value, better accounts. Yes.
And is the same accounts where we are targeting earlier, or these are different accounts? Because the number of accounts has gone down by almost 15% compared to last year.
Yes, the focus is precisely on that, because the idea is to really refocus on MSME, refocus on agriculture, and then of course the home loans, auto loans, LAP, and everything is under focus. And all branches are encouraged to do this work. We already have 850 branches. So obviously a lot of contribution can now come across the country towards the retail growth.
Okay, thank you.
Welcome.
Thank you. We have the next question from the line of Gaurav Jani from Centrum Broking. Please go ahead.
Yeah, thank you for taking my question. Just want to understand the structure of the non-fund exposure that we had to take as NPA. So how would the transaction have been structured initially?
It was done sometime in 2013 or early 14. I think it is as a group of banks, the entire funded exposure was converted into non-fund exposure, which guaranteed an overseas loan for the company, which would have definitely reduced their interest cost and help them move ahead and with a better repayment schedule and a better repayment plan. And these structures are in line with the RBI approvals in that area, and that is how it has been done. Only thing is, the company did not perform well, could not meet all the commitments under the obligation, and they have been trying to meet, but at the same time, the latest round, they were not able to service it correctly, and it got devolved. And anyway, the company's operation levels are also, I think, pretty low today. Yeah.
So this would be in a form, in sort of a corporate guarantee or something. I mean, where we would have guaranteed someone else's funded exposure. Would I understand that correctly?
Obviously, that is how it is, because some foreign banks or one of the foreign intermediaries would be giving the funded part. We have to guarantee that funded exposure by way of a non-fund facility. Yes.
And if I can know, so what would, we would also have taken some fee income on that, right? How much percentage would that be?
We would have taken a small amount of fee. So long back, 2013, 14, really I can't remember, or I don't understand. I don't remember also what was the number.
Just trying to understand the structure, as in, so how do we recognize fees on such transactions?
There would have been a fee income also, obviously. That structure typically provides for a fee income also. Yes.
And fee income is recognized on a pro rata basis.
Okay. Got that. And I guess the write-off that we have done is also directly flowing through, right? I mean, that 150 crore of slippage and 150 crore write-off?
Right. Okay. Because we we would of course pursue recovery in a different manner, but we don't want to keep it in our book anymore as such as an exposure at the moment because it's not working.
So we already had 90 crores of provisioning on that, and we have basically recognized a further 60 crores in this quarter, right?
Which is what I have been mentioning all along. See, this is a non-fund exposure, the commitment to another institution. We cannot make it NPA just like that. So that was the divergence, and we were not able to do anything about it because, I mean, the rule doesn't permit recognizing a non-fund facility as NPA. So that's the divergence which we couldn't deal with at all. Apart from the fact that we could keep on providing for it. That is what we have done.
Sure. If I may just squeeze two questions on this. So, is it a consortium-based exposure, and the quantum of that, if I can have that?
It is a consortium of some 3-4 entities. Yes. I can't immediately put a number on, the total exposure.
Okay, sure. And just if this may be a predecessor from a systemic perspective, can this be also expected for other banks? I mean, if RBI comes out with directives of recognizing non-fund based exposures as NPS, is it possible in this quarter?
We may not be able to really say anything about it precisely because non-fund exposure, if it is inherently weak, yes, RBI can give a direction that there should be provision against that. Yes, that's about all. In our case, anyway, this facility got invoked. It is not really out of RBI's directive alone. It is more about the fact that the company was not able to service the facility, and therefore the invocation happened.
Thank you. We'll take the next question from the line of Ashwini Agarwal from Baroda Pioneer Mutual Fund. Please go ahead.
Thanks for the opportunity, sir. So out of a total exposure to NCLT of 650 crores roughly, can you identify how much would be in metals and EPC, and what is the provisioning in each of these individual sectors?
What comes to my mind immediately is about one EPC account of around 200 crores is we will be required to provide almost 100% in that account. So we are significantly on line with that.
If I remember
50%.
So if I remember correctly, you said your provision coverage is 41% of the total 650 crores roughly, right? So that is roughly 250 crores.
Correct.
So in this exposure of EPC, you have to provide 100%. That is 200 crores, right?
Yeah, we have to. But we have already provided significantly. It is not, the average is 41. Yeah.
So total provision is 250 crores out of 260 crores out of 650 crores.
Correct.
And this EPC contract itself will require a provisioning of 200 crores.
Correct.
Roughly. So for the rest 450 crores, your provisioning is just 50 crores. Because where I'm coming from, I'll tell you. Typically, if you see last week, it was mentioned in the parliament itself that the overall haircut would be in the range of 60 to 65% for the metal companies, and which are backed by assets. And in EPC accounts, there are no assets. So the haircut is around about 80 to 85%. So what's the total amount of provisioning which you are likely to make in next 1 year? Because this is what I'm arriving at.
Right now we are making a provision of 50% as required by the RBI or in line with the provisioning regulations. Okay. So whichever is the higher one, we are required to make, and we are making it. So that's the way the regulation is. Now, if it depends on what kind of EPC contractors are involved. In some cases, they have assets, significant amount of assets. We would have also taken collateral security, which we can enforce. So there are many things beyond merely the classification of the account. So all those individual details I cannot explain here, but at the same time, the fact is the color is different. That's what I was trying to say.
Okay. And so the credit cost of 1%, you said it was excluding the provisions which you might have to make on the NCLT cases, right?
NCLT cases, we are already making 50% provision. In any case, by this quarter end, by the Q4.
By Q4.
Absolutely. as per there is a requirement, there is a regulation. So that anyway we will be making. So that is why we always mention that we would have around 200 crores of provision, even elevated level of provision, even in the next quarter.
Okay, sir. Thanks.
Yes.
Thank you. Due to time constraints, we will take the last question from the line of Sangam Iyer from Shubhkam Ventures. Please go ahead.
Yeah, hi. Sir, it's just a continuation of the last question. Just wanted to clarify, we have done around 240 odd crores of provisioning on the 650 crores of NCLT accounts that we have got currently. That's the correct understanding?
Yes, more or less, yeah.
Right. So out of the 650, if we bifurcate it between the EPC and the rest, so we have 450 and 200 crores.
Correct.
200 crores we would require the full 100% provisioning, and the balance 450 crores would require additional 50% provisioning, which is around 225 odd crores. So basically we would require a total provisioning of 425 crores for the NCLT exposure that we would have. Right? Mathematically that's how it would work?
Yeah, something similar, but exactly, that may not be the exact case, because it also depends on what provisions we are carrying, what securities we are carrying, and what resolution plans we are having in between. Yes.
Right. But given the fact that, we have to maintain a minimum of 50% for the non-EPC and say 80 to 100% for the EPC, I mean, that's where the mathematical number...
80 to 100% for EPC is not there. 80 to 100% for EPC is if the resolution does not happen satisfactorily. Yes.
Correct. So but I mean, given that our aim was that towards that, that's what I was just trying to arrive at in the mathematical. So the Q4 provisioning that we are looking at around 200 crores would purely be for the NCLT part of it. So for the aging and other provisioning, so how much should one be factoring in addition to the NCLT part of it, which would be there in Q4? So because Q4 provisioning could be much elevated than the 200 crore that we are guiding for. That's what I'm trying to understand here.
It would be more or less in that range only, because it's also, we may be carrying some provision, and we are also carrying securities which we may be able to encash in this particular period. These things are there.
Okay.
Yeah. Okay. So I mean, that part I am not able to because these are more account specific details, I am not able to talk about it. But we may be carrying specific securities in some of the cases, including some of the EPC cases, very specific securities which we can encash.
So on a broader perspective, you are saying that all put together, 200 to 220 is the max provisioning that one might require in Q4.
Yeah, that is the level of provisioning that we would require. That is what we have calculated roughly. Yes.
Perfect. Sir, one more thing. I mean, in one of the participants had asked regarding our incremental slippages that we are looking at the gross level for FY19 on a quarterly run rate. We indicated that it would be between 100 to 110 or 115 odd crores per quarter. Okay, that's at the gross level. And given that we are currently doing a recovery and upgrades, both cash recovery and the upgrades put together of around 100 crores. So we are saying that at the net level, the incremental gross NPA that one might be looking at might not be more than what we have seen as an exit rate for FY18. So FY19 gross NPA should be equal or lower than FY18 gross NPA in absolute terms. Is that what we are alluding to when we are...
ratio in any case will not worsen.
Sir, not the ratio in absolute terms.
And it depends on, I mean, how much we can recover, how much we can settle, how much we can sell off. These are the three things which are available to us. Some of the corporate exposures, we can definitely try all these three. And some cases we have taken specific securities also, land and mortgages and things like that. So we will
that would be in addition. That would be in addition to the current, because currently we did a recovery upgrade of around 90 crores.
Yeah.
So is that run rate?
Sangam, may we request you to come back in queue for follow-up questions due to time constraints? Thank you. In the interest of time, we would request participants to ask one question per participant. We will be taking few more questions. The next question is from the line of Rahul Maheshwari from IDBI Asset Management. Please go ahead.
Thank you for the opportunity. I have two questions. In recent just now commentary, you told your advance growth is exactly in the line of the branch expansion which is taking place. So going forward, currently you are at 851 branches. So going forward also the branch expansions would be in the similar lines kind of thing, or what kind of the growth rate you are expecting into the branches?
Yeah, I was actually mentioning advances growth in line with the branch.
Yes.
Yeah, not exactly branch growth. we don't need any more branches to do a 20%, 30% kind of growth, because we already have 850 branches in all the important places in Kerala, in South India, and in North India.
But what kind of number per year or per quarter the branch opening would be taking place?
We were looking at earlier about 50 branches, branches or extension counters. The orientation was towards opening more extension counters than branches, because that is a better way of assessing the potential in a particular area and then deciding whether it should be converted into a branch or not. So that is a better way of trying our expansion in a particular geography. Apart from strengthening a central branch in a major industrial location, for example, so creating a cluster around that. So these are the two opportunities that we are looking at.
So any ballpark number you are guiding for FY 19-20?
So numbers are actually around that 50, same number remains, but at the same time we are still, the board approval is not there for anything less than that at the moment. But at the same time, we will definitely have a relook at it, and then we will decide what is the correct, expansion strategy. But the orientation is towards cluster of branches rather than opening new branches in untested areas completely.
Okay. And no doubt because of the one-offs and the cost income has increased to 50%, but going forward, as you have told that there are sufficient branches and your approach would be towards cluster of branches, what kind of cost income you would be targeting and kind of the operating leverage, because you told more and more retail loan growth products comes, so CASA comes into the branches and all this. So what kind of cost income we can target in FY 19 and FY 20?
So we were looking at, we have already mentioned 47 as of now, and our desire is to bring it down to 45 and below going forward. But 47 is the guidance that we have mentioned so far.
And in FY 20?
Definitely the desire is to keep it well below 45. Well below 45. Towards 40 it should be, ideally.
Okay. Thank you so much, sir.
Thank you. We will take the next question from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you. My questions have been answered.
Yes.
Thank you. We'll take the next question from the line of Rakesh Kumar from Elara Capital. Please go ahead.
Thanks for the opportunity. Just two questions. Firstly, we have seen quite a lot of rise in ticket size in the mortgage and SME loan over the period of time. So what is the basic reason behind it? In the times, especially when the SME loans are, slightly more concerned than we had in the past. So if you can just elaborate on that.
Yeah. Now our idea is, is only that there was a lack of focus in the MSME and retail loan for some time, and that focus we are trying to bring back, and we are also creating all the structures and systems needed for that. So today we have a beautiful retail hub, which oversees all this processing, that is to be done as far as the retail loans are concerned, and business loans up to 2 crores are concerned. Then we have a separate processing center for the mid corporates, that is from 2 crores to 25 crores, and the third one for the wholesale processing of loans, that is more than 25 crores. So all these structures and systems have been put in place, and there is a whole lot of monitoring and traction that is happening from the HO, from the retail hub, etc. in terms of follow-up. And with all these things, today we are trying to steadily improve the ticket size also, and we are trying to look at good opportunities, good customers, and including even takeovers if such opportunities come in, with the clear understanding that we also focus on collateral security where such security is available to us. So this is the way we are focusing on this. So very risk controlled, careful expansion. That is what we are looking at.
Okay. Secondly, sir, over the past 1 year, we haven't done, any branch expansion. But if you look at, total operating expenses to the asset, that number is stable. So basically, if the branch expansion had been there, this number would have been, slightly on the higher side, would have been slightly different. So asset growth has been there, but branch expansion not there, but that ratio number is stable. So basically, like net profitability is looking slightly elevated in absence of branch expansion. So if we go for a branch expansion going ahead, I think profitability could be slightly more compressed. So your view on that?
So basically, it's much more important at this point of time to improve the efficiency of the existing branch network itself. So we are talking about 850 branches and another 50 extension counters. So with 900 units in place already, a lot more potential for growth is available to us. And it is I think the primary task today is to really activate this network, use a lot of technology, and use a lot of centralization capability to reach out larger number of customers, and use the branches as the focal points for growth in some of the important areas. This is all what we are trying to do. And so immediately a very large branch expansion is certainly not on the cards. It's not required. It will be a lot more of centralized and focused marketing efforts. Today there are 248 people in the market. They are called business development officers who source CASA, institutional CASA, government CASA. Then they also look after cross-selling and third-party marketing. They also look at asset marketing. So there's a whole lot of change compared to whatever has been happening earlier.
Thank you. We'll take the next question from the line of Ankit Chaudhary from Equirus Securities. Please go ahead.
Thanks for the opportunity. Rohan here. I just wanted to understand, we have started on hub-based...
We are not able to hear very well. The voice is breaking. Could you please speak again? Yeah.
So is it better? Hello?
If you are not audible to us, if you are on speaker, please turn that off.
Is it better? I'm on headset now. Hello?
Please carry on. I'm not able
to... Okay. So I was trying to understand, the hub-based sanctioning model that we have now for the retail and SME loans. So, after its implementation, what kind of employee productivity improvement would we have seen, branch and employee productivity, if you have done some analysis on that?
Yeah, now basically productivity has improved is something we can mention because across the branches, the sanctions have improved. Of course, the sanctions are done through the retail hub and the centralized processing centers, but the branches have mobilized all those loans. We don't use DSA, DSTs today, although we are exploring that opportunity also, but today the entire sourcing is done by the branches. So the number of sanctions have increased significantly across all the branches. So therefore, the productivity of the branches has definitely improved. And what we are doing is, at the moment, the monitoring is more done from the retail hub in terms of the retail loans, and we know per branch what is coming in terms of the sanctions, in terms of disbursements. And what we are trying to do is to get a separate, study. Our consultants are IFC, and they are doing, a monitoring of the productivity improvement across the branches, which is part of their mandate.
Thank you. We'll take the next question from the line of Anusha Raheja from LKP Securities. Please go ahead.
Thanks for taking my question. So what's the provision that you're holding against your restructured assets?
It will be between 10 and 15%.
Okay.
Because some of them are restructured slightly earlier, therefore, they are not having the 15% provision.
Okay. And, what could be the hurdle rate of your AFS investment book, beyond which there could be possibility of making market losses?
AFS duration is around 3.
Sorry, come again?
Hurdle rate. Further provisioning, how much
the duration is only 3. So rate movement, even though slightly moving up also, we are not having much problem in that.
Thank you. We'll take the last question from the line of Hiten Jain from Invesco Asset Management. Please go ahead.
Sir, do we have any exposure under 525 and SDR?
SDR and CDR, etc., are already in the NPA book only. But as far as 525 is concerned, we have two accounts and with a total exposure of 305 crores.
All right, sir. Thank you.
Thank you. That was the last question. I now hand the conference